Robert turns 52 and buys a rental property. Michael turns 52 and builds a dividend stock portfolio. They both want the same thing, monthly income without working forever. They both think they made the smarter choice. They are both wrong. Because Robert forgot that rental income at 52 comes with a price tag that has nothing to do with money. And Michael forgot that dividend stocks at 52 require a discipline that most people simply do not have. When you run the numbers over 15 years, the difference will change how you think about retirement forever. The fair setup. Let's keep this fair. Robert and Michael are both 52 years old. Both have $120,000 saved and ready to invest. Both earn $72,000 a year. Both want to retire comfortably at 67. Same city, same financial starting point. The only difference is how they plan to generate income in retirement. Robert uses his $120,000 as a down payment on a $380,000 rental property, a solid 3-bedroom house in a decent neighborhood. His mortgage payment is roughly $1,800 a month. He finds a tenant willing to pay $2,400 a month. On paper, that's $600 in profit. Robert feels like a genius. Michael takes the same $120,000 and builds a dividend stock portfolio. He invests in a mix of dividend growth stocks and dividend ETFs. His average dividend yield is roughly 4% annually. That generates approximately $400 a month in dividend income immediately. He reinvests every dividend automatically and adds $500 a month from his paycheck. His coworkers ask what he's investing in. He says dividend stocks. They smile, say, interesting, and immediately reach for their phones. Dividend stocks do not make for great office conversation. Year 1, feelings. On day 1, Robert has a property, a tenant, a rent check, a dinner table announcement ready to go. He drives past his rental on the way to work and thinks, I own that. Michael has a brokerage account full of company names most people recognize: Johnson & Johnson, Procter & Gamble, Coca-Cola. He receives his first dividend payment, $398 deposited directly into his account. He did nothing to earn it. No phone calls, no showings, no keys. Robert feels like he's winning by a mile. Michael feels like he's playing a quiet, long game. It's not even close in terms of how it feels, but your gut feeling has never paid a mortgage payment. The numbers have. And after 50, the game is no longer about building wealth fast. It's about building income that lasts. The hidden costs of rental income after 50. The $600 monthly profit is the number everyone talks about. It's the number on the landlord spreadsheet, the number at the real estate seminar, the number your landlord friend mentions proudly at every family gathering. What nobody talks about is everything that quietly destroys that number, especially when you're over 50. Number 1, your body has a timeline. At 32, climbing into an attic to check insulation feels like hustle. At 58, it feels like a liability. At 65, it feels impossible. Rental property management is a physical job. Most landlords do not realize how much their own physical involvement costs them until they're 64 and can no longer do it. Number 2, every repair is now a retirement withdrawal. When Robert was 35, an unexpected $8,000 roof replacement was painful but survivable. At 62, that same $8,000 comes directly out of his retirement savings, not his paycheck, his retirement, the money he was counting on to last 25 years. One bad repair can permanently damage a retirement plan. Number 3, vacancy hits differently in retirement. When Robert was working, a 1-month vacancy meant a tight month. When Robert is 65 and retired, 1 month of no rent means 1 month of paying a $1,800 mortgage from savings. That's not an inconvenience. That's a direct attack on his financial security. Number 4, tenants do not care how old you are. A difficult tenant at 35 is stressful. A difficult tenant at 63 is devastating. Eviction proceedings, legal fees, property damage. 3 to 6 months of lost rent. That single event can erase an entire year of retirement income, and the stress alone has a measurable health cost. Number 5. Michael's portfolio has never sent him a panic text. It's never needed anything from him, not once. Every quarter, it simply deposits money into his account, whether he's sleeping, traveling, or sitting in a hospital waiting room. The income arrives without asking anything from him. That's the difference nobody puts on the real estate seminar flyer. Year 1. Robert is 52, Michael is 52. Robert has collected $28,800 in rent. His mortgage payments totaled $21,600. Gross cash flow looks like $7,200, but then subtract property taxes of $4,200, insurance of $2,100, a plumbing repair of $900, 1 week of vacancy costing $600, his actual net cash flow year 1 approximately $1,400 to $2,200. Not $600 a month, more like $120 to $180 a month after all costs. Michael's dividend portfolio at 4% yield on $120,000 generated approximately $4,800 in dividends year 1, all automatically reinvested. His portfolio, with $500 monthly contributions and 10% total return, grew to approximately $138,000 to $142,000. He made 0 phone calls, attended 0 showings, fixed 0 pipes. Year 3. Robert is 54, Michael is 54. Robert has raised rent to $2,550. Cash flow is improving, but he replaced a water heater for $1,300, had one difficult tenant who left minor damage costing $2,200 to repair. His actual net cash flow over 3 years above all expenses, roughly $8,000 to $14,000 total. Not bad, but not the passive income story he imagined. Michael's portfolio at 54 sits at approximately $185,000 to $198,000. Dividends now generating roughly $620 to $660 per month, automatically, reliably, without 0 management required. Year 5. Robert is 57, Michael is 57. Robert's property is roughly $450,000 to $480,000. His equity has grown to approximately $155,000 to $185,000. Leverage has worked beautifully, but Robert is 57. He's tired. The property management is wearing on him. He starts thinking about hiring a property manager. That costs 8 to 10% of monthly rent, roughly $200 to $240 a month gone immediately. His already thin cash flow drops further. Michael's portfolio at 57 sits at approximately $265,000 to $285,000. Monthly dividends now generating roughly $880 to $950 per month. Still automatically reinvested, still requiring 0 management. The dividend income alone has nearly matched Robert's net rental income without a single repair bill. Year 10. Robert is 62, Michael is 62. Robert is approaching retirement. His property is roughly $660,000 to $720,000. His mortgage is nearly paid off. His equity is approximately $600,000 to $680,000. He's house rich, but to generate monthly income, he must either sell, refinance, or keep managing a rental property at 67. He decides to sell. After agent fees of 5 to 6%, capital gains tax on appreciation, and closing costs, he walks away with approximately $520,000 to $580,000 net. He then invests that into income-generating assets at 67, starting over as an investor at retirement age. Michael, at 67, has a portfolio sitting at approximately $680,000 to $740,000. Monthly dividends generating roughly $2,260 to $2,470 per month, automatically, reliably, without selling a single share. He's been collecting and reinvesting dividends for 15 years.
The compounding has done the heavy lifting. He doesn't need to sell anything. He doesn't need to manage anything. He simply lives on his dividend income while his portfolio continues to grow underneath him. The gap is not close. Michael has more income, more liquidity, more freedom, and he spent 0 weekends dealing with tenant problems.
Defending rental property after 50. If I only showed you the downsides of rental property after 50, I would be doing what every stock market influencer does. Rental property has real advantages that dividend stocks simply cannot match. Leverage is the most powerful wealth builder available to ordinary Americans. Robert used $120,000 to control a $380,000 asset. Michael used $120,000 to control $120,000 in assets. That leverage gave Robert $600,000 in equity on a $120,000 investment. No dividend portfolio can replicate that return on initial capital. Rental income is inflation-proof in a way dividends are not. As inflation rises, Robert raises rent. His income goes up automatically with the cost of living. Dividend payments can be cut during recessions. Rents rarely drop in high inflation environments. And real estate has tax advantages that are genuinely powerful. Depreciation reduces Robert's taxable rental income every year. A 1031 exchange lets him sell and reinvest without paying capital gains tax. These are legal tax shelters that dividend investors simply do not have access to. Defending rental property after 50. Rental property after 50 wins in specific identifiable situations. If you already own rental property with systems in place, an experienced property manager, and strong positive cash flow, continuing absolutely makes sense. You have already paid the learning curve. If your property is in a high appreciation market where values grow 5 to 7% per year, the leverage multiplies your wealth in ways dividends cannot match. If you use a property manager from day one and treat it as a true business, the passive income story becomes real. The workload disappears, the cash flow remains. And if your rental income is your primary retirement plan and you have owned the property for 20 or more years, the paid-off mortgage generates cash flow that rivals any dividend portfolio. The close. Dividend stocks are not a boring investment. They are a misunderstood one. Robert and Michael both walked away from that decision thinking they made the smarter play. Robert thought tangible property meant reliable income. Michael thought dividends meant passive income without strategy. Neither of them actually sat down and mapped out what each choice costs, in time, in stress, in liquidity, and in the hidden price of managing an asset during the exact years when your time is most valuable. The real trap after 50 is not rental property, and it is not dividend stocks. The real trap is choosing either one without asking yourself one honest question. How much of your retirement do you want to spend managing an asset versus actually living your life? Because that answer, your honest answer, is the only calculation that actually matters. And if you're wondering what happens when Robert hires a property manager on day one and Michael combines dividend stocks with rental income at the same time, that is a completely different conversation, and the math might change everything you think you know. Now, I want to ask you something directly. Are you currently relying on rental income or dividend stocks for your retirement plan? Or are you still trying to figure out which one makes more sense for you? Drop your answer in the comments below. Tell me your age and your current strategy. I will reply to as many as I can and tell you exactly which approach fits your situation best. Because the right answer for your age and your income is the only answer that actually matters. Disclaimer: this video is for educational purposes only and is not financial advice. Please consult a licensed financial advisor before making any investment decisions.